Okay, sorry about that. Without Bjorn, who usually does the recording, I feel like I'm flying without a co-pilot. Okay, so Bart is going to tell us about anti-competitive price referencing. Bart would love your questions whenever you have them, so please just raise your hand and ask your question. And of course, the chat option is open as well. Bart, thanks so much for joining us. Please go ahead.
Thank you very much for having me. It's a great pleasure to joining this this online webinar. So very happy to share my recent research with Vincent, who's also here online. So this is our paper title, Anti-Competitive Price Referencing. Okay, since Vincent is here, right? So again, you're most welcome to ask questions along the way as I talk, but also Vincent will handle them some of the questions on the chat if there are any. Okay, so relatively simple schedule for today. I'm gonna talk about the motivation and give a preview of the result, and I will set up the baseline model. And if time permits, I will tell you the extension why we do that and what do we get out of it, and I'll conclude. Okay. So motivation and preview. We know that almost half of the U.S. equity volume is off exchange, and these off exchange trades, according to the order protection rule, essentially requires price referencing, right? So when a trading center tries to execute a trade off exchange, it has to refer to the on exchange because it has to prevent this off exchange trade from executing at an inferior price, inferior to the protected quotations from the on exchange quotes, right? So I'm in particular thinking of the following scenario just to make this price referencing idea very concrete. So I'm thinking of the trading of retail trades. Okay, so imagine right now the national best offer, the best ask price is $10. Bart, as a retail investor, submits a marketable buy order through my broker Robinhood. Okay? Robinhood routes my order to Citadel, which in the terminology of SEC is a trading center in this case, because Citadel is going to execute my order against its own inventory. Okay. So how does Citadel execute my order? It checks the ongoing NBO, so national best offer, which is $10, and decide to trade my order at a price just better than the NBO. So sometimes it gives the price info. Okay, so at least it has to be lower than $10. So here is the price reference. Okay, so Citadel checks the NBO for where the current best price is. So it seems all good, right? So the rule, the OPR or this kind of price referencing ensures that Bart, the small potato, is not screwed over by these big players. They don't charge me crazy prices, sort of the idea behind it. So we will argue in this project that this is actually partial. So we're going to argue this is this behavior of price referencing is actually anti-competitive. Okay. So I'm going to do a little bit more math. I'm going to abstract the example into some notations. Okay? So far, it's exactly the same example as in the previous slide, but I'm going to introduce some new notations. Instead of saying that the on-exchange best price is $10, I'm going to give it a notation, say it's going to be the price P on exchange. Right? In the model later, we're going to do just full transparency. Right? So in the model later, we're going to do is a double auction on the exchange. So we are not going to have bid and ask. It's going to be a single price on exchange when it clears. Okay, so that's the price P. When I submit a order through Robinhood, I'm going to abstract that to an investor submits a buy order of size Z hat, which is positive. So, and I'm not going to specifically model the broker. Broker in our story is going to be a behind the scene kind of player. It does not explicitly play a role. So think of the broker as some kind of competitive agent, doesn't extract any rent from the game. Okay. So this broker is going to submit, this investor is going to, through the broker, submit a order of size Z hat. Finally, this Citadel, so the market maker / wholesaler will check the price P and execute the Z hat order at a price P hat just below P. Okay, so that's the abstracting of the example into some notations. So what is going on? Let's think about incentive of the market maker or the wholesaler here. Okay, I'm the wholesaler. Okay, I got this order of Z hat, and I want to set a very high price P hat because I want to maximize my sales. Right, so P hat times Z hat. So everything with a hedge is off exchange. Okay? Everything without hedge is on exchange. But the p hat, because of the because of the OPR order protection rule, is constrained. It cannot exceed the on exchange price p. Bart is buying, so it cannot exceed this on exchange price. Therefore, as the market maker who also provides liquidity on exchange, I will ask myself, okay, if I want to set the p hat as high as possible, why don't I compete less on the exchange in the first place, so that I can lift the p a little bit? I can relax the constraint a little bit if I compete less on the exchange. I have all the incentive to do so because I want to maximize my off-exchange sales p hat out multiplying z hat. Okay? This incentive is particularly strong if the z hat is large. Right? The more orders I receive off-exchange, the stronger the incentive I have to not to compete on the exchange, so that I can improve the price. Okay? Another way of saying this is that, in fact, I want to have a larger Z so that I can discipline myself not to compete on the exchange in the first place. Yeah. And this is what we call the anti-competitive price reference. What's the key? The key here is that the on-exchange price P is not exogenous. It's jointly determined together with the off-exchange P hat by the market makers. Market makers are playing a double role here. Their competition, their liquidity supply on exchange is their strategic choice. And that is also influenced by how much off-exchange trading they will do. And in this incentive, in light of this incentive, we argue that the market makers would compete less on exchange the moment they have off-exchange exposure. So hopefully this intuition is clear. Right. So I'm happy to take questions here if there's anything to clarify about this intuition. If not, then basically we study the model to formalize this intuition. Right? So one thing to note is that for this incentive to work, we will have to have a binding constraint. Right. So this constraint, p hat is less than p must be binding. Otherwise, this incentive doesn't go through. So the model basically sheds more light on the details of this intuition along this line. Okay, we'll use the model. We'll use this model to answer other questions like what happens to the overall market quality, and why do the investors in the first place send the orders off exchange, and can we find remedies to sort of fix this anti-competitive incentive? Okay, as I
so
just
can I ask,
oh sure,
quick question. So for the on exchange, off exchange, anybody can choose to send it sort of off exchange to the broker, or so it's not like retail versus institutions, just to.
Right. So very quickly. So ideally, I would defer that to the model, but very quickly, we don't really distinguish the investor types in our model. There's only one type of investor. And they are small, so their orders are sort of exogenously being fragmented into on and off exchanges. As I was just quickly flashing, I forgot that we did actually a reality check. Right, so basically we asked the question, is this kind of mechanism realistic? And we do find some empirical anchoring in the literature. Right, for example, Anne and Andre and Ingrid have this recent paper documenting a lot of details of this retail trading business. And one thing that struck us as echoing our model predictions, that they find that the trades executed by these wholesalers off exchange typically incur significantly higher spread costs, especially for small stocks where the retail trades relatively more. Okay? And Tom and Chester have this paper on options market where they look at designated market makers randomly assigned on different options exchange. When they internalize sort of like the off-exchange trading, these option orders, they also earn larger spreads. Moving to Europe, we also have evidence that high-frequency traders, when they execute volumes on the single dealer platforms, again, it's kind of like off-exchange, their on-exchange spreads also become wider, and coming from Fatima and Lars' paper. So there is some empirical evidence which makes us more convinced that this mechanism is somewhat in play in reality. Okay, so that's why we write on this model. Okay. Very quickly to preview what the model does.
Bart,
there are a couple
would you like to take some questions? Okay.
Yes, please. Do I just take the sequence from Giovanni? Yeah.
Hi, Bart. Comes to mind, is this in any way related? Have you thought about relating this to there's an idea in IO, which is multi-market contact that weakens competition. I mean, the market makers here are active both on exchange and off exchange. And this is the reason why they can play around with prices to weaken competition by lowering their aggressiveness on exchange and exploit that off exchange. Is that somehow related to the logic of your example?
Yes, I guess if I understand your question correctly, yes, precisely because they can play around at the same time, right?
Okay.
That's how they I don't want to use the big word, but kind of manipulate the price.
Okay. There's a literature in this on something which is related in IO, which
literature, right?
Multi-market contact.
Okay.
Yeah, that
yes.
was my point too. There's a very extensive literature on price matching and whether price matching is, never knowingly undersold kind of price matching, whether that's anti-competitive or not. So you really should take a look at the IO literature. There's a lot written on it. Yeah.
Yes. Let me quickly comment on that. Yes, we did look at it. In fact, that was our initial motivation. We thought that these were very related, indeed, to markets and in the price matching literature. Right? So Best Buy would say, whenever you find a better price, you can come to us. We'll match the price. We initially thought it was very similar, but as I will show you once I set up the model, the mechanism is actually different. It's actually different. We did think of that. So hold on a little bit. I will try to get there. Okay.
Okay. Thank you.
Yeah, Pete.
Yeah, I may be repeating the same comments, but I think if you and I agree to trade, a specific quantity, whatever the price is going to be at an auction at a specific time, we can both participate in the auction. There's a theorem that says that the price is going to be exactly the same as it would be if we didn't make the agreement, because we'll just offset whatever our agreement was in our trading. And so there must be something else going on in your model that undermines that Modigliani-Miller equivalence. So my question is, what is it?
Right. In short, in the baseline model, there is no auction in the off-exchange market. As in the reality, we have the market maker absorbing the order flows routed to them. They don't need to compete. There is no simultaneous market. In extension, there is something else that's going on. Hopefully, I will get there, and you will see what the difference is. But hopefully, that's well, again, I want to go to the model so you can see exactly what we are doing there.
Okay, so I'm assuming it's that one of the traders. I was talking about the auction and the exchange, but okay. I'm assuming that one of the traders is committing not to trade on the exchange to undo what he just agreed to do with the off-exchange trader.
No. So again, please let me get to the model. So sorry about this. So hopefully you will see. Just very quickly of the key results here. So in the baseline, we simply set the off-exchange price exactly the same as the on-exchange price. So we exogenously specify this price referencing group P hat equals to P. And the setup is a double auction on exchange to determine the market clearing price P. And then off-exchange simply sets exactly P hat equal to P. Okay. What happens is that, again, before getting into the model detail, there's another result I want to highlight, is that because of price referencing, the market fragmentation is endogenously sustained. This is because investors are indifferent where to trade. Doesn't matter his or her order is routed to the exchange or off exchange, he or she is always going to get the same price. P hat equals to B. This means that brokers' fast execution obligation is always fulfilled. And this facilitates the market makers who want and can therefore fragment the market, for example, via the PFOF arrangements, because the prices are always the same. Okay, so fragmentation becomes endogenously sustainable in our model. And intuitively, the moment you have anti-competition or lack of competition, the intuitive suggestion to solve the problem is to just inject more market makers to make them more competitive, compete against each other. we basically show that this cannot fix the issue. This is because there are two effects going on once you introduce the market makers. On the one hand, yes, there is the direct effect that they increase the competition mechanically simply because there are more market makers, which reduces the illiquidity. But there is also an indirect effect, right? So more market makers would like to fragment more orders off exchange. Essentially, they want to enlarge their Z hat, if you remember my example. And the more orders they have, the more orders they have off exchange, the more illiquid the market becomes because they have even less incentive to compete on exchange. So this indirect effect can undo some of the direct effect. In fact, we show that at least in the specification of our model, this indirect effect can dominate. As I increase the number of market makers on the horizontal axis, what happens is more and more orders, this blue line, are siphoned off exchange. So the fraction of on-exchange orders, this R, becomes smaller and smaller. In the meantime, the illiquidity, what we call zeta in the model, becomes higher and higher. So that's hurting the market outcome, the market efficiency. Okay? And this is with the OPR because the market makers have to refer to the off-exchange price. If we switch off the OPR, then what happens is the market makers can no longer siphon the orders off exchange because investors know that the moment they send an order off exchange, the market makers are going to charge an infinite price. In our static one-period model, that's the case. Okay. And that's why the investors or the brokers have no incentive to send orders without the OPR off exchange. And they will send orders on exchange. And then we have the natural outcome. If you increase the number of market makers, the liquidity becomes better. Illiquidity becomes lower, and we have a more efficient market. So this gives us an insight in terms of the role of the order protection rule from the angle of our model. We basically show that market makers have the incentive to commit to price referencing, for example, to set the P hat exactly to P. In the one-period model of our baseline, they cannot do so without the OPR, because once there is no order protection rule, this one-period model would suggest that the orders off exchange will be charged at infinite prices. Okay? Therefore, essentially, the order protection rule or the no-trade rule is serving as a commitment device for the market makers to refer to the price. But this is not necessarily the only possible commitment device, right? In a more elaborate multi-period model or sort of a dynamic model we are working on, you can easily see that in a steady state, the market makers can commit to price referencing even without the OPR in place. Okay? And we have some extension where endogenize the price referencing rule. Instead of exogenous P hat equal to P, we endogenize this via their off-exchange competition. Okay, so that's sort of the overview of the result. And once we get there, we can talk more about these results. So if there are no questions about the previews of the results, I will get to the model next. Okay, so baseline. We have the, we call it the price referencing by design because we're going to fix the exogenous price referencing rule. We're going to have the the exogenous will P hat equal to P. Okay, and the concrete setting we have in mind is the handling of the retail orders, as I motivated with at the beginning. So sketch of the model, we have two kinds of players. We have a continuum of small investors, retail investors, for example, and we have N large market makers, 1 all the way to N. Okay? And we have two trading venues, on exchange and off exchange. The investors are liquidity demanders. They send marketable orders, and these orders are fragmented to exchange with probability R and R hat off exchange. And if it is off exchange with some fraction R hat 1, small R hat 1, it goes to market maker 1. With some fraction R hat, small R hat 2, it goes to market maker 2, so on and so forth. Okay. And once the orders are routed to the market makers, just like in the handling of retail orders, these market makers execute the orders off exchange against their own book. Okay? But at what price? Well, that price is exogenously referred to the on-exchange price. So that's the liquidity demand meets the liquidity supply. So we let the market makers supply liquidity schedules on exchange to clear the exchange market at the market clearing price P. And this is also the price that they're going to refer to in the off-exchange internalization at the same as P hat. Okay. So from the model's perspective, we're going to do two things. We're going to solve the model backwardsly. We're going to determine the liquidity demand, the liquidity supply, and the market clearing price, these colored terms endogenously. That's the trading stage. And then there is the fragmentation stage in the before trading. So that's the red part. We're going to endogenously determine R, how the orders are fragmented into the market makers as well. Okay, that's the preview of the model. Model details. We have one risky asset that's paying B units of some risk-free numeraire. Okay? And we have a liquidity demand coming from the continuum small investors of total size mu. Okay, I'm going to highlight the role of the mu or the lack of the role, the lack of the role of the mu later in the analysis. We assume the investors have a quadratic inventory cost like the following. We can also do Kara. Just the quadratic utility is just easier to calculate. The Kara solution we also have in closed form, and it's exactly the same. And they trade for two reasons. They want to hedge a future endowment of U units of the risky asset. They also speculate a private information, which for simplicity we assume is perfect about the asset value. Okay? So they know exactly what V is. So liquidity supply, as mentioned, there are a bunch of large market makers. They're risk neutral. They don't have any inventory costs. Again, these are intentional choices. So we will make the only friction in the exchange market, the market makers' market power. They are large. Okay? They maximize their expected profit. They cannot observe U or V. They have to infer it from the order flow submitted by the liquidity demanders. Some standard assumptions: V and U are independently normal with means V bar and 0, and the variance is 1 over tau V and 1 over tau U. And we also need the number of market makers to be sufficiently large, a standard assumption in tau type of frameworks. The exact condition is in the paper, but for now we just assume they are relatively large. Okay, trading, how does that work? Before trading happens, each market maker chooses her off-exchange exposure RJ hat, small rj here, at a cost, a linear cost of kappa times how much of the orders they're getting in total, right? So in total, there's mu measure of investors, mu unit of the orders, and RJ hat times mu is the amount of orders they get off exchange, and kappa times that is basically the total linear cost they pay for siphoning that amount of order off exchange. And we require, of course, these fractions to be between 0 and 1, and R hat is the total amount of orders off exchange, also between 0 and 1. Trading happens by submitting the orders. So on exchange, the market makers supply the schedules XJ of P to supply liquidity, and each investor submits the market order ZI of V and U, their private information. Okay? And then once the orders are submitted, each order is independently routed with probability RJ hat to market maker J, internalized by the market maker J. Okay? And with the rest of the probability cap R, so 1 minus R hat or 1 minus the summation of all the small RJs, the order ends up on the exchange. Okay? And market clearing condition, right? So the total supply on the exchange equals the total liquidity demand. So a fraction of R of the total market orders submitted. And so this brings down the equilibrium price of P. Off exchange, basically how much you submit to supply liquidity must equal to the liquidity demand off exchange that's being routed off exchange. Okay, that's it. We determine the 3 sets of endogenous items here: the liquidity demand XJ of P, the liquidity supply XJ of P, the liquidity demand ZI of V and U, and in the pre-trading stage, we're going to solve for the optimal siphoning by the market. Okay, now we're going to solve the model backwardsly. In the trading stage, we fix the fragmentation. Every market maker gets her own fraction of the orders, R small r hat. And then we conjecture the linear strategies and standard techniques. So investors use a linear strategy, which is a combination of the private information V and the hedging demand U. And so beta I is basically the aggressiveness of how much liquidity they demand, and gamma I is the aggressiveness in hedging their endowment shocks. Similarly, we have a linear demand or supply function for the market makers. They supply liquidity according to the aggressiveness coefficient Bj. So beta j, beta I, gamma I, and Bj are the coefficients we're going to endogenously determine. And notably, we want to emphasize Bj as the aggressiveness of the market maker's liquidity supply. And for notation simplicity, we're going to use the cap B as the summation of all the liquidity supply aggressiveness by the market makers. And liquidity demand is relatively standard. It's a quadratic optimization problem. So you have a linear solution, just a linear combination of the V and U as we conjectured. You can substitute P into the equation because of the market clearing condition. And you can pin down the coefficients, right? So the liquidity demand aggressiveness, beta I, is increasing in how much liquidity supply. B here, the larger is the liquidity supply, the larger is the liquidity demand as well. And gamma I is basically determined by the quadratic inventory cost coefficient role of the investors. We're going to drop the subscript I from here because they're homogeneous investors. Moving on to the liquidity supply side, they understand that the order Zi is the aggressiveness coefficient beta times the T, which is the information signal extracted by the investors, linear combination from their coefficients. Okay, so the market makers can infer this signal T from the market clearing price P, and they do the standard Bayesian updating, and the P coefficient is the phi, which is just the projection coefficient here. Okay? And then they can optimize. They solve the following optimization problem. It's the product of two brackets. The first bracket is basically the marginal profit of every order. Every order I supply liquidity for, I earn a price of P, and I pay the cost of selling the order at the of its fundamental value, conditional expectation of the B. How many units I sell, that's Xj, how much liquidity I supply on exchange, plus Zj hat, basically how much liquidity demand I receive off exchange. Okay? And P is a function of Xj because that's the market clearing condition on exchange. Right? So my supply plus everyone else's supply under the linear conjecture must equal to the total liquidity demand on exchange. And standard solution, and that's the key insight here from the model. We have two components, right? So the first component is where the exchange only liquidity supply. And the second component is where the distortion coming from. That's coming from my off exchange exposure. Because I receive Zj hat units of the orders coming to my off exchange from brokers, for example, and that gives me a lower incentive to supply liquidity on exchange. In particular, for example, if the Zj hat is buying, that means I supply, like minus Zj hat, I supply less liquidity on the exchange. That's the idea, right? So earlier we were discussing the comparison with the IO literature on the price matching, right? So it's so the story in this IO literature is like I know that if you come to me with a better price, I'm going to match it. Because I commit to matching such a potentially better price, I don't have any incentive to offer a good price in the first place. Here, it's a totally different mechanism. It's because of my off-exchange exposure Zj in the first place. That disciplines me not to compete as fiercely as possible on exchange. And so that's the distortion coming from the off-exchange exposure. We can then pin down the coefficients, which just an ugly expression here for now. So I'm not going to explain too much on that. Okay. So I do want to take this slide to something more general. So here we are assuming a specific price referencing rule. If you remember, P hat equals P, exogenously specified. But what if this is more general, right? So imagine P hat is a generic function of P, some kind of referencing, but not necessarily exactly the same as P. Then essentially we have a very similar problem here. The first part is my profit from providing liquidity on exchange. And the second component is my profit of providing liquidity off exchange. The only difference is that the first part is the on exchange price P. And the second part here is the off exchange price P hat, which refers to the on exchange P according to some function P hat. Okay. So if we take the first order condition and solve for xj, we get a very similar expression as before. Right? There are two components here. One is the on exchange only supply, and there is a distortion coming from the exposure off exchange here, ZJ hat. To compare, earlier in the previous slide, under the specific price referencing rule, essentially we have dp hat over dp equal to 1. That's why we have this specific component here. Here, if we allow a more generic function of how price refer to off exchange price P hat refers to the on exchange price P, then we have a derivative of P hat, a dp hat over dp hat, dp here as the distortion, part of the distortion. So this is actually very insightful. It tells us where this distortion really comes from. It requires three things. One is that dp hat has to respond to dp, right? So this derivative has to be non-zero. So there is price referencing. That's the prerequisite. We have the price reference. The second condition is that zj hat cannot be zero, right? If it is zero, I don't have any off-exchange exposure, then this distortion doesn't occur at all. A last condition that's a little bit subtle here is that dp over dxj, so the market makers have to be large because we are inverting this price impact here. If we don't, this coefficient is zero, then we cannot invert this. Then we don't have this price distortion effect either. So we need all these three conditions: market makers being large, there is off-exchange exposure, and the off-exchange price is indeed referencing the on-exchange price for this distortion to happen. Okay. So coming back, once we have these mechanisms, let's summarize the trading equilibrium. There is a unique linear strategy equilibrium with the following coefficients: bj, beta I, and gamma I, all given in closed form. And in particular, the price return, right, the market clearance price relative to the pre-trading unconditional price of the asset V bar is given by zeta times the efficient price. So zeta times the conditional expectation of the asset price. What is zeta? Zeta is the illiquidity index that has the following expression. Okay. Here are some intuition or insight coming from this expression. Zeta is going through everything, right? So it's going through the price, it's going through the liquidity supply aggressiveness. It also goes through the liquidity demand aggressiveness beta. And it is strictly larger than 1, right? So it is particularly large, so illiquidity is particularly high if there are few market makers, which is very intuitive. The market makers don't exist, then they don't compete, and the illiquidity becomes high. What's new in this model is that the illiquidity is very high if R is small. What is R? As a reminder, R is the fraction of on-exchange orders. If a lot of orders are siphoned off exchange, that means R is small and the illiquidity becomes high. Okay? So more orders off exchange, and the market makers have less incentive to compete on exchange. But note that this zeta is independent of the total size, the absolute amount of the investors. So that's a special result because we assume the market makers are risk neutral. They don't have any inventory cost, so they don't have any risk sharing motives among themselves. So everything scales with proportionally with the fraction on and off exchange. The total number of investors don't matter. And that's an intentional choice. We really want to highlight the fact that it is the fraction of the orders that's being fragmented in metals. Another thing you can see that zeta does is amplifies the volatility of the price. So if you have more orders siphoned off exchange, so R is small, then zeta becomes large and the volatility becomes high. Okay, and that means it hinders the trading by the investors. It hinders the liquidity supply, it hinders the liquidity demand, and lowers the trading efficiency. As mentioned, right, this is a sort of a reality check. These empirical papers share a similar predictions to what we find in terms of market quality about off-exchange trading. And another insight coming from the model is that the market makers' liquidity supply aggressiveness BJ is decreasing in their off-exchange exposure RJ hat. So look at this bracket here, the red part. If, remember, so far the RJ hat, the fraction of off-exchange exposure to a market maker is exogenous. If this exposure is very large, larger than 1 over n minus 1, then this term can indeed be negative, right? What's the incentive? If my off-exchange exposure is so large that I receive so many buy orders off-exchange, then the best thing for me to do is actually buy the orders from exchange and supply them to my off-exchange liquidity demanders. So instead of supplying liquidity, I turn to consume liquidity on exchange. So the overall illiquidity on exchange becomes extremely exacerbated. So here's, and finally, so this RJ hat affects not just the market maker BJ's liquidity supply, it also affects everyone else because it affects the on-exchange fraction of the orders R. And R goes through illiquidity and illiquidity goes through everywhere. So this is really a chain of reaction. The moment one market maker siphons some orders off exchange, it affects the total orders off exchange and affects everyone else's incentive to participate in the market. So here's the numerical illustration. On the horizontal axis, I'm increasing the market maker one's off exchange exposure from 0 all the way to something about 0.7. And you can see that her liquidity supply, B1, is decreasing, and it can indeed become negative after certain parameter ranges. In the meantime, everyone else, BJ, other than 1, is supplying less and less liquidity, and overall the liquidity supply also drops dramatically. So this is really a spillover effect of illiquidity across all the agents. All right, so far I have talked about trading equilibrium, right? So maybe I will quick check if there is any questions, or probably I ran a little bit too fast.
Bart, I think Peter, Giovanni, and Vincent are having an interesting chat in the chat. I wonder if Peter wants to say what he's thinking for maybe Bart to also opine.
Yeah, so I'm not completely, I overlooked the chat, sorry about that.
I think I may be able to maybe rephrase the question there. So just sort of thinking from the empirical standpoint, market makers are not the only liquidity providers on modern exchanges. There would be, for example, institutional market maker or institutions, period, who are building positions through limit orders, and they're providing liquidity that way. They're not internalizing anything, so they're not wholesalers. So they would love to compete in that market and provide liquidity, and they will be driving down the spreads on exchanges. I think this is pretty much what Peter is trying to say there.
That is exactly correct.
Yes, good. I heard that, and my quick response to that is that indeed our model allows that. Remember, maybe just look at this graph, right? So far what I've done is I have the order flows, the fragmentation as exogenous. You can totally think market maker 1 as this institution master that doesn't have any off-exchange exposure. So just set this R1 to be 0. It is possible. So some of our end market makers can indeed be these kind of on-exchange only liquidity providers you have in mind. And our model still works. The only thing we need is that some of the market makers, these market makers, are working off exchange as well. They have a non-zero small R hat J here. So yes, our model captures such on-exchange only market.
Yeah, sorry. So sorry, my camera is kind of broken, but I think I was already anticipating this comparative static exercise that you were speaking of when you increase the number of market makers, that it could actually be worse for liquidity. But I guess that would then depend on these must all be market makers that are internalizers as well. Because if you would sort of add pure, I would call the market makers that are not internalizers, then this wouldn't be happening, right?
Could you say the last part again?
So if you would only add pure market makers that cannot internalize, that would then improve liquidity, right? Because they don't have reverse incentives.
Right, that's right. That I haven't touched on, but yes, if I only add market makers who cannot siphon or who cannot fragment orders, yes, that will improve the liquidity.
Okay, perfect. Also, like a good back test whether I'm
yeah. All right, so anywho, so let me get to that, right? So far I haven't really endogenized the market maker's choice of fragmentation. So let's try to do that. So that's the red part here. So that's the first stage. So we first derived the expressions of on exchange expected profit using our trading equilibrium here. So some expression of the illiquidity here. So in fact, the only thing that matters is the illiquidity for the market makers. Their choice of RJ hat goes through these illiquidity zetas everywhere here. Okay. So then she basically chooses the RJ hat to solve the to maximize the total profit, the trading profit, less the cost to acquire the off-exchange order flows. So think of this cost as kind of the payment to the brokers, like their PFOF costs. And basically we show is that there exists a unique symmetric strategy equilibrium in which the market makers all acquire the same amount or hat. Now, coming back to what Peter just said, right? So we haven't really done the asymmetric equilibrium, which we do believe exists. What we have done so far is we say all these market makers can acquire orders off exchange. And if they really do, here is a symmetric strategy equilibrium. Okay, and that's what we found. Under this symmetric, so here are some details of how to find that equilibrium. I'm skipping those. So under that symmetric strategy equilibrium, here are some interesting results. One is that if you increase the cost to fragment, so this higher kappa, for example, if the PFOF becomes more costly by regulation or by the market power of the brokers, which we don't really model, suppose that cost increases exogenously, then the market is actually more liquid. What's the intuition? That's because the market makers have trouble now acquiring orders off exchange. So they cannot fragment the orders anymore, and the market actually becomes more liquid because of that. On the other hand, if we increase the number of market makers, again, in this symmetric strategy equilibrium, they will acquire more orders off exchange. And therefore, the market becomes less liquid and there is less trading gain achieved. Okay? And that's sort of the numerical illustration. If we increase the cost of acquiring orders off exchange, then we have an increasing amount of orders that's going on exchange because the market makers can acquire less. And because there are increasing more orders on exchange, the illiquidity actually drops or liquidity improves. On the other hand, if we try to fix the problem by injecting more market makers and, again, allowing them to acquire orders off exchange, then it's problematic because these more market makers will acquire more orders off exchange. So the total amount of the orders that's still off exchange will become increasing, and still on exchange will become decreasing, and illiquidity will just exacerbate. So more market makers actually hurt. Right? So that's the intuition. It all goes through the zeta, goes through the R here. The direct effect is this N. It reduces illiquidity. A larger N reduces illiquidity. But there's the indirect effect. They acquire more orders off exchange. The R becomes higher, becomes lower. Therefore, zeta becomes higher. The illiquidity becomes higher. Is this realistic, right? So again, I'm going back to Andre's paper. So they basically show interesting episode where a new market maker entered, and once that market maker grabbed the market share, stabilizes the operation, the spreads and actually increased and volume dropped. So the market indeed became less liquid once new market makers entered. So we think this can be happening in reality as well. Again, this is more phenomenal in smaller stocks, where the retail trading is higher fraction in first place. Now, let's take a pause here and understand the effect of the OPR. Right? So this is the result we just saw when there is the OPR. And if we instead shut the OPR down, we saw the opposite, right? Because now in our static model, the market makers can no longer siphon orders off exchange because the investors will not believe them. The investors will know that they're sending orders to a monopolist who will charge them infinite price. And knowing that, essentially, the market makers can acquire no orders at all. All the investors will send their orders back to the exchange. So liquidity begets liquidity. You will have a much better overall market equality once you remove the order protection rule. Again, that's only in our static setting. In a more elaborate, repeated game kind of setup, you can imagine the market makers can find alternative ways to commit to a better price off exchange. So they can still siphon orders off exchange, and the price referencing mechanism can apply again. So the OPR essentially is just a commitment device in our model. Okay, so that's sort of the baseline, sort of the model where we take the exogenous price referencing rule as given. Are there additional discussion that I'm missing here? Okay, so if not, I will go to the extension part to fix the next thing that's not very satisfactory in the baseline model, which is the exogenous referencing rule, right? So far, this p hat equal to p is assumed to hold exogenously. But what if there is endogenous determination of the p hat as well, right? For example, the SEC's new proposal rule, the order by order auction, is essentially saying that all segmented orders, so the retail orders, must be first exposed to an auction. So the market makers have to compete for such off-exchange orders. Okay? This will essentially establish endogenous constraint of p hat and p. So it's no longer the exogenous constraint. So I'm going to endogenously do that. So quick preview of the model, very similar to what I did in the baseline. Now we have three types of agents. On the one hand, we have the liquidity demand as before, the investors. On the other hand, we have the cross market makers that can both operate on the exchange and off exchange as before. And now we have a new category of investors, that's the local market makers. And that's sort of related to what Peter said. There are market makers, institutions that can provide liquidity only on exchange. And these are particularly relevant for the SEC's proposal, right? A key focal point of that proposal is to encourage all these eligible market makers or liquidity providers in general to participate in this kind of off-exchange auctions. But for various reasons, either they are not aware of this kind of a very short frequency auctions, or they cannot, their technology does not allow them to participate. There will always be some of these local exchange only market makers that cannot participate also off exchange. Okay, so they can only participate on exchange. So that's the three types of agents we have. Again, we have on exchange trading and off exchange trading. And similar to before, the liquidity demand orders are submitted by the investors, and part of them route to the exchange and the rest route to the market makers. Different from before, instead of executing these orders against their own book by these cross-market makers, these cross-market makers now have to run an auction. So all of these cross-market makers can participate in the off-exchange auction as well. Okay? And finally, the supply liquidity, right? So both the on-exchange local market makers as well as the cross-market makers supply liquidity to the exchange. And while off-exchange in the auction, these market makers also supply liquidity to compete for the marketable orders here. Market clearing determines the prices, the on-exchange price P and the off-exchange price P hat. And again, we do two things. We first solve the equilibrium of the trading equilibrium, and then we solve the the fractioning of the orders in the first place. Okay. Just to compare, the difference from the baseline is that previously all the orders are traded off exchange one by one for each market maker, and there's no local market makers. Now we have the all the orders must be competed. So off exchange is in the auction, and there's additional on exchange local market makers as well. Okay. All right. The setup is more or less the same as before. The only difference is that we have now N plus L total market makers. N of them are active on both exchanges. They are the cross market makers, and L of them are local. They're only on the exchange. And trading is, again, very similar to before. The cross market maker supplies two schedules, XJ on exchange and XJ hat off exchange. Local market makers only supply liquidity on the exchange. So they supply the schedule YJ. And each investor submits a marketable order just like before. A fraction of them, R of them, go to the exchange. The rest, 1 minus R, go to off exchange. And note that here we don't need to specify the small RJ because all the orders go off exchange must be auctioned off together. So we only need to know the R hat here. We don't need to know the small R hat. And market clearing determines the P and P hat. This is on exchange where you have both the cross market makers and the local market makers to supply liquidity. Off exchange, you only have the cross market makers to supply liquidity. I'm not going to solve the model in detail, but just give you the key insight here and to see the similarity and the differences of the model. Okay? So the investors' orders is fragmented into on-exchange Z and off-exchange Z hat. Right? So there are mu of them, each of them submits beta T. So R of them are on-exchange and R hat of them are off-exchange. Okay? And then the market makers solve the following problem. They supply liquidity XJ to clear the on-exchange liquidity demand. For each unit, they get a P minus the conditional expectation of the asset value. For off-exchange trading, they have XJ hat and they execute at the price P hat. And again, the asset value is the conditional expectation of the given T here. They do so subject to the OPR constraint, which says the P hat off-exchange price must be better than the on-exchange price. Okay, so if the order flow is buying, so the sign of Z hat is positive, that means these orders must be executed at a lower price off-exchange P hat than the on-exchange price. Okay, so that's the constraint. That's the constraint this optimization is subject to. I can rewrite this optimization problem into a Lagrangian. Right? So the first component is the profit as before. Now we have a Lagrangian coefficient omega j here. And this is the constraint we saw earlier. Okay. Now, what this rewriting does is it gives us the following first order condition. It's very similar to before. The key difference is, right, remember, this is the first part without any off-exchange exposure. So if your Z hat is 0, then this is what you get. This is your pure on-exchange liquidity supply. Now we still have a distortion. Okay, that's the effect is similar to the baseline here. The key difference compared to the baseline is that the shadow cost of the Lagrangian coefficient is in place of dp hat over dp. So this shadow cost is really what drives the price referencing, is in place of the how the p hat refers to the p here. Okay, and if this shadow cost is very high, that means that the off-exchange price is very binding. And that's where this constraint is kicking in, and this reduces your on-exchange liquidity supply. Another difference is that the off-exchange order flow Z hat is in place of the ZJ hat, and that's because of the OBO auction. Right? So instead of each market maker J gets her own ZJ hat, all the order flows must be competed. So that's the Z hat here. Okay? Now, if you look at you do the same for the off-exchange liquidity supply XJ hat, you get a very similar expression, except that here it is positive. Instead of minus omega JZ hat, you have plus omega JZ hat. So what this tells you is that because of the OPR constraint, the liquidity supply is shifted from on-exchange to off-exchange. So the idea is that I reduce my liquidity supply off-exchange to make my off-exchange price, I reduce my liquidity supply on-exchange to make my on-exchange price worse, while I improve the liquidity supply off-exchange to make my off-exchange price better so that I can mitigate their gap. I can equate their prices to conform with the order protection rule. Okay, so that's the idea of the model. It tells us how the equilibrium works by shifting the liquidity from exchange to the off-exchange. Ugly notations, but basically Bart, we characterize the equilibrium. Yes, Andre.
Just in terms of time management,
yes.
I think in about 5 minutes, some folks may start logging off because we usually go for an hour. And so up to you if you'd like to continue, but potentially lose some comments from people who have to leave. We could do it, or we could try to wrap up quickly, catch some comments, and maybe detailed discussion later. Up to you.
Yeah, so basically I'm there, right? So we can characterize the equilibrium exactly the same as before, and we have a very similar mechanism. In some sense, this extension is more like a robustness check of the baseline analysis. Okay, so let me just conclude here and take more questions. What we do in here is we study the behavior of price referencing. Well, it might seem very innocuous in the first place, but the more we think about it, the more we think it is kind of anti-competitive. That's the key message here. Okay, so if there are questions, I'll be more than happy to hear your thoughts here. And the paper is just being written, and we're still in the process of revising it. So any kind of suggestion will be super helpful there. Thanks very much. Yes, Marius, please.
Hi, Bart. Really nice paper.
Thanks.
There's something that I'm not super sure I understood relative to the timing of the orders. It seems that referencing in your model happens with respect to like an ex-post price, right? But that's the price after all the whole orders have been worked through. Whereas in practice, you're referencing the inframarginal price, referencing the best bid and ask, which is why I think in your model there's nobody can come in and like undercut by a tiny amount and then basically screw up the entire anti-competitive. So
let me.
I think about the timing of the orders and when does the referencing happen in practice.
So the model itself is static. Because I'll first talk about model. The model itself is static. So both the on-exchange price and off-exchange price is determined at the same time. So it itself doesn't have this sequentiality. That's the model. Now, in reality, what you said is, yes, in reality, nothing is really simultaneous, right? So the physics prevents really everything happening at the same time. There's always a little bit of difference. So in reality, when when I'm the market maker, I execute an order off exchange. I look at the ongoing price on exchange. So if you believe that ongoing price on exchange can be affected by the market maker at the same time when he or she is executing the order off exchange, then this is more or less as the same as what our model is suggesting, right? So at the time I execute the off exchange order, I can still manipulate or influence the order flows, the prices on exchange. That's how we think about the timing.
But it's not really simultaneous, right? You need to work through the entire on-exchange order to fix that clearing price. And then everything else happens at that clearing price.
So you think the which one is first? The on-exchange?
The on-exchange. The on-exchange is first. And then, there's this whole risk being unloaded on the market makers.
Right. So I do think in reality, yes, the on-exchange prices are formed first. But the question is, as they are being formed, do the market makers have incentive anticipating the off-exchange orders being routed to them or may be routed to them? I think yes. So I still think it's maybe there is something I don't see, but I think it is a reasonable characterization that knowing that I'll have orders off exchange, my initial competition on exchange is being negatively affected. I think it is a fair way to look at the model. But yeah, thanks. We need to think more carefully about the timing.
If we have more questions, could we just email you directly? Because given the time here, we have to go.
Oh, sure. Thanks.
What's your email?
By the way, we are not limited on time here. So unless you have to go.
Yeah, I have to go. Sorry.
Okay.
Yeah. And then what's the email?
My email address?
Yes, sir.
So I can type it in the chat if you can see that.
That'd be great. I appreciate it. Thank you.
That's great. Thanks.
Thanks again. This was great.
Thank you.
Bart, would you like to read Dominic's question, or would you like me to?
Hi. Oh, hi. Yeah, sure. I can see that, Dominic. The determines off exchange. I think LPR, but with two different changes too. Yeah. So in the model, we take a stance, right? We want to match it to off exchange because for our application, the handling of the retail orders, I think that's most relevant and realistic. But the mechanism can also apply to on exchanges. There are some subtle differences, but yes, if we have two exchanges, they refer to each other, right? So the OPR applies to both exchanges. We believe the same mechanism can apply. Then be careful. The only thing we want to say here is the OPR is not, we don't want to put the OPR as the culprit, so to say, because it's just one way for the market makers to commit to price referencing. There are different ways for them to. So on the exchange, yes, two exchanges also have the same incentive thing. No, sure, okay, I can read. That's okay. Your keyboard works. That's important.
All right. Any more questions, folks? I feel bad now for interrupting Bart earlier.
No, it's okay. It's okay. Thanks. It's good to have the discussion here.
All right. Well, now that you all know Bart's email, if there are any more questions, I'm sure that he and Vincent are going to be happy to respond to those. Bart, thanks so much again for staying up so late and joining us.
Thanks for having me.
And for the rest of you guys, next 2 weeks from now, we have a paper about Robinhood effects on liquidity costs. So we are continuing along the path of trying to understand modern market structure as far as retail trading is concerned. Hopefully you will be able to join us, and thanks for joining us today.
Thank you.
Thank you.
Thanks, Bart.
Thanks so much.
Bart.
Thank you.